Hello everyone, today we will present our take on the case study of Infineon Technologies. Infineon is a semiconductor company known for its diverse product portfolio, including power semiconductors, microcontrollers and sensors. Notably, power chips make up a substantial 60% of the company total revenue, while DRAM, also a major revenue source, has become a commodity with volatile pricing. The company operates through three main units: automotive, industrial and multi-markets, and ship, car and security. To excel in these markets, Infineon invests significantly in ERD, a common industry practice. Moving on to Infineon's financial analysis, its performance between 2008 and 2011 saw a significant improvement. Concerning two market ratios, market cap increased substantially, reflecting investor optimism, primarily driven by a rising stock price in the last 3 years of the analysis, with an exception in 2009 due to the global crisis. In response to the crisis, Infineon implemented strategies to address its substantial debt, including raise funds through a convertible bond, selling assets and a rights issue, which boosts investor confidence and the stock price. We have the price-earnings ratio, which shows that in 2010 and 2011, Infineon's profitability improved significantly. It recorded positive financial profits and stock price increases. The price-earnings ratio in 2010 was 8.38, although it decreased to 5.43 in 2011 due to a substantial increase in net income. Considering the dividends per share, Infineon faced net losses in 2008 and 2009, resulting in the non-distribution of dividends. However, improved financial health allowed the company to resume dividend payments, providing predictability for shareholders. In 2010, it distributed 10 cents per share and 12 cents per share in 2011. Consecutive negative net income in 2008 and 2009 negatively impacted the return on equity. It turned positive in 2010 and 11, primarily driven by the improvement in net income. For example, with a net income barely over 1 billion, the company presents a return on equity of 33%. We also analyzed the leverage ratios. In 2008, Infineon was significantly dependent on debt, as evidenced by the balance sheet. However, the debt-to-equity ratio decreased considerably in 2009 due to a debt repayment program. In 2011, debt represents only 9% of the book value of equity, indicating a healthier financial position.
Now, regarding Infineon's capital structure, it has evolved over the years to meet operational and growth challenges. In 2008 and 2009, the company heavily relied on debt financing, including both bank loans and bond issues. However, by 2010 and 2011, Infineon effectively reduced its debt burden through a debt repayment program and raised equity through share issuances such as rights issues and IPOs. The current capital structure in 2011 is supported by the recovery from the global financial crisis, marked by debt reduction and successful investments. This positive outlook allowed Infineon to attract more equity financing. Now, in terms of cash management, Infineon maintained a significant cash balance, reaching 2.4 billion euros in net cash by late 2011. This approach aimed to provide financial flexibility, especially in a cyclical and capital-intensive industry. The uncertainty of the investment needs and potential downturns in the industry reinforced the importance of this financial flexibility. Infineon was selective in distributing excess cash, returning value to shareholders through dividends both in 2010 and 2011 and share buybacks while preserving financial flexibility. The high demand for its products in the last year resulted in substantial cash reserves, and this practice was influenced by past experiences such as the Qimonda episode, in which emphasizing the importance of cash reserves to face unforeseen crises was seen as really important. The company's funds primarily came from product sales, which generated significant operating revenues. Additionally, debt financing was used through external borrowings like convertible bonds and bank loans. The allocation of funds was primarily directed towards research and development, capital expenditures, debt repayment, and then maintaining cash reserves for financial flexibility. In summary, various capital structure and cash management theories can be applied to this case. The trade-off theory suggests a balance between debt and equity in the capital structure, with Infineon adapting its mix over time. Then, the pecking order theory. It indicates a preference for internal financing, retained earnings, over external financing, aligning with Infineon's cautious approach to external financing. Lastly, the agency costs theory comes into play when considering how management decisions affect stakeholders and the need for corporate governance mechanisms to mitigate agency costs.
In this section, we will examine Infineon's dividend payout policy, how it evolved over the years under analysis, and its relation to theories of dividend distribution in the literature. In markets with information asymmetry, dividends can serve as signals of a company performance to shareholders, as proposed by Baskin and Miranti. Littner suggests that companies tend to increase dividends when they expect future profits to be stable. Infineon faced challenges in defining its payout policy due to conflicting expectations among shareholders and investment opportunities driven by positive cash balances. In 2010, CEO Peter Bauer's announcement of a steady-state dividend policy had a positive impact on the market following the bird-in-hand theory. This theory suggests that investors prefer dividends over reinvestment, reducing uncertainty about future cash flows, which can lower the company's cost of financing and increase its share price. It also relates to the signaling theory, which addresses information asymmetry, allowing the company to signal its stability to investors through dividend distribution. The decision to pay dividends was influenced by Infineon's improved financial position, driven by significant net cash flow figures, including the sale of the wireless units and the atypical profits in 2011. Some analysts raised concerns about the company accumulating cash, pointing to the agency costs hypothesis by Easterbrook, which suggests that withholding capital can protect investors from agency costs stemming from suboptimal investments by managers. The pressure on the company to invest the surplus is addressed in the hypothesis of the clientele effect, where investments with varying tax rates prefer companies with dividend policies that suit their preferences. The discussion on how Infineon should distribute its cash surpluses included different preferences among investors in the US, Germany, and the UK. Littner's theory of the relevance of dividends explained that in certain markets, investors prefer receiving dividends over uncertainty, and managers are reluctant to change in the dividend policy unless they are certain it can be maintained. Tax benefits influence the company's decision on its payout policy, aligning with the tax effect hypothesis, where capital structure is determined by tax benefits, especially when dividends are taxed at higher rates than capital gains.
Infineon uses financial instruments like put warrants and convertible bonds to manage its capital and return value to shareholders. Positive market conditions, company outlook, solid credit rating, and market liquidity are crucial for the success of put warrants and convertible bonds. Concerning put warrants, they provide the right but not the obligation to buy or sell the securities at a predetermined price before maturity. Infineon issued warrants to conduct open market share repurchase and signal its commitment to returning capital. These instruments give a positive signal to investors, indicating the company's confidence in its stock price. However, the choice of put warrants can be risky due to the high volatility of Infineon's stock prices. Despite this allowing Infinity to receive premiums, the size of the program had a relatively small impact on the cash balance. Now to convertible bonds, they can be converted into the issuing company's common stock at investors' discretion. These bonds allows companies to attract equity at a higher price than the current stock price and acquire debt at a lower interest rate. The coupon rate on convertible bonds issued by Infineon during the financial crisis was relatively high, lowering the cost of capital if repurchased. Despite Infineon may experience losses if the repurchased convertible bonds, these losses could be tax deductible. Also, repurchasing convertible bonds can be beneficial if Infineon expects its stock price to rise and aims to improve its credit rating. In conclusion, the use of these financial instruments in Infineon's capital management strategy depends on market conditions, stock price expectation, and the company's credit rating goals. While put warrants may not be the most suitable in some situations, scaling up the use of convertible bonds seems advisable.
To sum up this analysis, we have assembled some recommendations for Infineon's future policies, divided it into three main aspects. About cash holdings, we believe it is important to maintain a high level of cash reserves to ensure financial flexibility and agility, given the sector's sensitivity to macroeconomic fluctuations. However, we also believe that there is some margin to invest excess cash in short-term, low-risk opportunities to generate additional income. Moving on to capital structure, Infineon should maintain a reasonable debt-to-equity ratio, around 0.6, and balance the benefits of debt financing, like tax shields, against its costs, such as bankruptcy risks. Infineon could also use financial instruments like convertible bonds to reduce some of its debt and reduce even more interest expenses. Finally, about dividend and stock repurchases. It is our opinion that Infineon must continue to pay regular dividends as a sign of financial health and prospects of growth. It also should consider a balanced approach to returning capital to shareholders, including stock repurchase and put warrants to adjust payouts based on market conditions. However, the specific mix of dividends and stock repurchases should be carefully analyzed based on financial position, growth prospects, and market conditions.
To conclude, our presentation involved a detailed analysis of Infineon, covering financial indicators, capital structure, dividend distribution policies, core activities, and business strategies. This case study provides valuable insights into the application of financial theories to drive Infineon's operational strategies and offers lessons for other companies. It underscores the importance of financial flexibility, strategic planning, and adaptability, especially during crises when companies may need to quickly adjust their plans. The risks associated with over-reliance on a single product or product line are highlighted, as seen in Infineon's memory chip business. Lastly, the significance of transparency in decision-making and communication with shareholders is stressed for maintaining credibility with investors. Thank you.